let me begin by highlighting a few misconceptions that we might have. The first one is central banks will not let a financial crisis happen because they know what the problems are, they can see them coming, and they can fix them before they happen. That's a myth. OPEC stabilized the price of oil and are in control of the oil markets. Stock markets are a good long-term investment. And finally, China is an economic powerhouse and will lead economic growth in the future. All of these are incorrect. All right, how I like to begin, I always begin my presentations with a talk on why do we have financial crisis. So first of all, I'll go through that. What were the problems? What were the solutions? Do we see signs of another one happening? And then what we do at Quorum Centre is we highlight global economic trends, and for you, what I would like to do today is only focus on 4 of them. And the 4 would be central banks, which are debt and interest rates, oil, stock market, and China. And then finally, I'll wrap it up and give you a summary. All right, why do we keep having financial crisis? The first question many people ask me is, well, come on, we just had a financial crisis. Don't tell me we're having another one. And I always say, well, that's the way it is. We always have them. It's part of the system. If we all studied economics, we all know economic theory. There's an economic cycle, right? You have a growth period, a peak, a slowdown, and a recession. This is a normal part of the economic system. And roughly 4 to 7 years between each cycle. Now, this cycle has gone back 200 years, and over a 200-year period, that always shows you that this economic cycle is intact. You always have a growth period, you always have a peak, you always have a slowdown, you always have a recession. This is the United States. This chart is from the Federal Reserve. It goes back to 1948. So from 1948 until 2017, there have been 11 recessions. That means, on average, there's been a recession in the United States every 6.2 years. The shortest cycle was 1 year. The longest is 10 years. So where are we on this cycle? Well, our last recession was end of 2008, beginning 2009. We're roughly over 8 years now, almost 9 years. So theory would say, in 200 years of history, it says that we are actually at the end of our economic cycle. So to say that we're not headed for a slowdown is a misconception. What's unique about this one is it was also one of the steepest we've seen since the end of World War II, and it was the slowest in terms of growth. So as you can see, the growth has been slower and slower, and we're seeing stronger and stronger recessions. This is really the reality of what's happening. Yes, the economic cycle is intact, but what's happening is the economic cycle is getting more extreme ups and more extreme downs, and I'll show you. Here are some past financial crises. We had the oil shock in 1971, the second oil shock, 1987, which is Black Monday, stock market crash, 1994, which was the Mexican peso crisis, which is still known today as the worst year for the bond market globally. The 2000 dot-com bubble, this one is still fresh in our memory, and the 2008 financial crisis. These are all global crises, but they're also regional crises that we tend to forget about. So we can see the 1989 SNL crisis, the Asian financial crisis, the Russian ruble or long-term capital management hedge fund blow-up crisis, Eurozone debt crisis, the Cyprus banking crisis, and a whole lot more. So what is that to say about 2017? Well, it says that chances are when we do come into a recession, there will be some type of crisis. But then we hear the chairman of the U.S. Federal Reserve saying she expects no more financial crisis in her lifetime. Now, this is a very idiotic statement, because how can you say that when you have history that says there's always going to be a crisis? And if we remember the last chairman, he did not see the last mortgage crisis coming, and he did not see the last recession coming. So how can we expect the current Fed chairman to see a crisis coming? They don't see him coming. This is the research from Deutsche Bank, and it shows you financial crisis going back to the year 1600. So over 4,000 years of economic history, and yet, as you can see, since 1960 roughly, economic crises have been fairly frequent around the world. So bottom line is the financial system is built on a boom and bust cycle. Ups and downs, that's part of the economic cycle that we're in. So we can always expect this to keep recurring. Were the problems of the last one solved? All right, this is the big piece right here is if you say we're not expecting a financial crisis, that means the problems of the last one were fixed. Let's take a look. The U.S. government did a inquiry into what caused the last financial crisis, and they came up with 4 reasons. The subprime, that was the biggest part of it. We have subprime, meaning poor quality credit was given to anybody who wanted it, regardless of their ability to repay. So subprime was one problem. Then you had banks that became so big that you could not allow one of them to fail, because if you allowed one of them to fail, that would take down the financial system, therefore they must be broken up. There's too much debt, and this is one that I like to focus on quite a bit. There's too much debt in the system, and that's what's slowing things down. That's what's making things more extreme. If you're a real estate investor, you know that by taking out leverage, it helps you when real estate prices are going up because your returns are improved if you take out debt. However, when prices are falling and you have debt, it actually hurts you. It makes things worse on the way down. And number 4, complex derivatives. These are the 4 problems. All right, so if all these 4 problems were solved, I would not worry. I would say, okay, fine. We're not headed for a crisis. Things are going great. But let's see how these 4 problems played out so far. On the subprime, if we look at headlines today, we can see in the UK, subprime is back. US subprime is back. China now has a subprime problem. Emerging market debts is at a record high. And of course, the paybacks on these loans to subprime borrowers are far worse than anticipated. So easy lending not only is subprime as it was in the past. Subprime in the past was the US housing market. Today, subprime is everywhere. In almost every country, every major economy has some form of subprime. Number 2, too big to fail banks. If we look at the top 6 banks in the US, which are JP Morgan, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, these are the top 6 banks in the United States. They control 2/3 of the banking system in the US, whereas almost 7,000 banks have the rest of the market. So 6 banks, 2/3, 7,000 banks, 1/3. That means the banks that are too big to fail are even bigger today. And of course, the big banks are famous for a few things. All of these banks that you see here have been accused of misleading investors, money laundering, LIBOR scandal, Forex scandal, gold manipulation scandal, silver manipulation scandal, and the list goes on. They're still paying fines today for things they've done in the past decade. And none of this has changed. The cycle continues. So of course, bottom line here is the big banks are still around. They're also bigger than they were in the past, and they're doing what they did in the past. Too much debt. This is the chart from the Federal Reserve. It shows you total U.S. debt in the United States growth. That's in red compared with GDP growth in the U.S. in blue. And what you're seeing here is from 1970 to today, debt has been growing at a faster pace than the GDP growth. So much so that it's been accelerating. And what this says that is debt is really the driver for economic growth. If you want the economy to grow, you must increase debt. But what happens if I reduce debt? Because I have too much debt, so I need to reduce it. Well, if you reduce debt, that little blip there, that's what you call a global financial crisis. Debt can never go down. Because debt goes down, it creates a crisis. Everything is built on debt. And what debt does is you're borrowing growth in the future to use it now. So therefore, to get that growth constantly coming in the future, you must keep on borrowing more and more and more at a faster and faster rate. So in 1970, if you needed 1% debt growth to get 1% of GDP growth, today you need 10% of debt growth to get 1% of GDP growth, and it's accelerating. So lower debt means crisis. And if I were to compare debt to GDP ratios of some of the leading economies around the world, I'm primarily using developed markets here. If you compare what happened before the crisis, so 2007, to the latest data available, which is 2016, you'll see that every country, government-wise that is, GDP or debt to GDP has been higher, meaning governments have borrowed more. What's interesting to note here is Japan. Japan's debt to GDP ratio is at a world record never before happened in history. I don't know how Japan's going to pay this back. Japan is in big trouble. They haven't had any significant economic growth since 1989, and their pattern has been continuing without any luck. What's also interesting to note here is Greece. Didn't Greece get 300 billion euro of bailouts to reduce its debt? Why did its debt to GDP ratio go up? So maybe I can answer that later for you. Here's another chart bankers in the Gulf like to see. The ones in yellow are GCC. The ones in blue are the rest of the world, or sorry, the European banking system. This is the percentage of bad debt in the banking system. And of course, when I was working at a bank here in the Gulf, we'd always get hammered by the rating agencies saying your debt to GDP or your bad debts ratio is too high. You need to lower it. You're going to have a bad rating. But if you compare the GCC banks to European banks, GCC banks are much lower. Usually what they say is if you have a non-performing loan, meaning bad debts of 5% or more, you're in a bad situation. If you have a bad debt ratio of 2% bad debts, the central bank calls you and wants to see your plan of reducing this. All of them in the Gulf, with the exception of UAE, are below 5%. And Europe is pretty much standard. They're almost all above 5%. And some are even above 10%. Above 10% is near bankruptcy for a banking system. But if you look here, here's Kuwait. And here's Italy. Greece and Cyprus, of course, we know their banking systems are bankrupt. But Italy and Portugal, for example, very, very high, nearing bankruptcy levels. If we look at it a different way, we see Italy here, for example, $280 billion in bad debts in Italian banks. 1/3 of all debts in Italy are bad. This tells you that the Italian banking system as a whole is bankrupt, and that's why they're having trouble today. So the global financial system calls for debt to ever be increasing, which means it can never be paid off. What happens is debt always needs to be refinanced into the infinite future. You refinance more and you borrow more. You refinance more and you borrow more. In the United States, they're saying that the United States always pays its debts. No, it doesn't. It always borrows more to pay back the old debt and borrows more to take on new debt. That's how the cycle works. The fourth one, and the most complex one, is the derivatives definition. And derivatives, simply put, are bets. They were originally designed in the late 90s as insurance, protection for investors, hedging tools, but they have changed to become more like financial instruments. But they're financial instruments not based on an asset, but based on a promise. And the promise is only good as the person giving you that promise. And that's what got into trouble during the last crisis. This is an explanation from the financial crisis report on how a derivative system works. And as you can see, it's not very easy to explain. They're very complex, they're intertwined. It's a bet upon a bet, and it could be sliced off into more bets upon bets. It gets very complicated. One example I like to give is you're sitting amongst your friends and you see your neighbor buy a new car. You know your neighbor is a terrible driver. So you tell your friends, I'm going to buy insurance that he's going to crash his car. But on what basis are you buying insurance? You have no interest in that car, whether you want to protect the value of it or not. All you're doing is making a bet because you think he'll crash the car. All of your friends say, well, I'll do the same thing. 20 of your friends go out and buy the same insurance. How can you buy insurance on someone else's property? And derivatives, not only can you do this, but you amongst your friends can issue each other insurance on this. So then your friend says, well, I'll give you insurance on this too. And your other friends do it. And then you start selling it amongst yourself and trading it. On what basis? That's how the unregulated derivative market works. There are regulated derivatives, which are futures, forwards, and options. These are traded on markets. They're very liquid. But then there are unregulated derivatives. And this is really the bulk of the problem. And I'll explain it a little bit more. This is from the OCC, the Office of the Controller of the Currency, which is the banking regulator in the United States. The number here is in billions, and as you can see here, this is in thousands. So the number we're looking at is in trillions. The derivative market in the US really took off in the mid-90s and really exploded after 1999 because of the deregulation of the derivatives industry. It started off as roughly $16 trillion in 1995, and it went all the way up in 2008 to around $230 trillion. That's the size of only the US derivative market. $230 trillion compared at the time to the size of the US economy, which is roughly 16 trillion. So you can see how massive this problem is. And of course, it started to come down in 2014, and that's an important number I want you to remember. We'll get back to this. And if we look at commodity derivatives, which is what oil is based on, there are derivatives based on oil, gold, silver, tin, iron, wheat, but they make up such a small portion of the overall market, but yet they're significant. This is from the same report. It shows you that these are total derivatives of these banks in millions of dollars. Citigroup, for example, has 54 million in derivatives, which is 54 trillion dollars worth of derivatives. Now, I don't know how this is possible, given that the total economy of the U.S. is roughly 20 trillion right now. So, if we look at all the problems that caused the last crisis, not only are they still with us today, they're actually bigger. So this leads me to conclude that when we do come to another crisis, which we will because we have 200 years of economic history backing us up, it says that it will be worse. And this is why we keep having financial crisis. It's always a cycle that keeps repeating. Are there signs of another one? I'll just give you briefs on this. We all heard last week UK's credit got downgraded. That's not a good sign. There's a huge pension crisis, not only in the US, but globally. Pensions are trillions of dollars underfunded, meaning that they have a funding gap in the trillions of dollars. We're hearing of a range of retail bankruptcies. Now, if the economy is doing well, retail, you shouldn't be having all these retail bankruptcies, but right now we're almost at a record level in the number of retail bankruptcies. Illinois, one of the states in the United States, is close to filing bankruptcy and will be the first ever. There are other states also that are in dire financial condition. They're close to filing bankruptcy too, and their rating is close to being junk rated. If the economy is doing well, why would you have states thinking of filing bankruptcy? Fitch did a report last year saying China has bad debts 10 times official estimate. And as we know, a lot of what's reported out of China, you have to take with a grain of salt. Fitch says it's 10 times worse than it's reported. And of course, rising defaults in the UK and China's export market is not doing so well. The term that we need to focus on, and what we say, why we're seeing a lot of this happen today, is the key word is financialization. Now, this is the term many of you probably have not heard, but financialization simply means taking something that is designed to be a good financial asset, a good financial investment, and changing it into a hedging, a speculative tool, similar to how they did in the stock market by taking day trading, high-frequency trading. Your whole purpose is no longer to participate in helping grow the company. You're not interested in what the company does. All you're interested in doing is in making a quick return. But not only has the stock market been financialized, and it's one of the most that has been financialized, another term they use is financial engineering. We've seen this across the board with all types of financial assets. Financialization really means when the financial aspect of the economy overtakes productive parts of the economy, like manufacturing, growth industries, new services, new businesses, and instead people prefer to focus on the financial aspect, meaning how can I make a quick return without really adding any value to the economy? That's financialization. And this is really what we're seeing today. All right, now I'll get to the global economic trends and show you where we are on some of these. And of course, I picked the ones that I think are most relevant to us here in Kuwait. Central banks and interest rates. Well, the funny thing about central banks, and this is not a central bank, this is the IMF, but the funny thing about forecasts is that they're usually wrong. And in the IMF's case, as you can see, as GDP was falling, they kept on giving a different estimate of how it's going to rise and improve, and it never did. All of their estimates over the past 8 years have been wrong. The only forecast that I've seen spot on accurate has been China. China says they're going to have 7% GDP growth. They have 7% GDP growth. They say they're going to have 6.8. They have 6.8. I've never seen this in any economy and all of the research that I've done. It also leads me to say, similar to how other economists have been looking into this and saying that, well, how much can you trust this number? A lot of it has to do with how they calculate their number and what targets and objectives they're looking at. But in essence, central banks are usually wrong in their forecasts. Didn't central banks save us from the last crisis? Let's take a look. We all remember this, September 2008. Markets around the world were falling apart, and the big thing here was credit markets were frozen, meaning banks didn't trust each other. They're all worried that they're going to go bankrupt. They stopped lending amongst themselves, and when they stopped lending, they stopped trading, etc. And it was a domino effect, and what happened was the entire financial system almost came to a halt, had not the central bank stepped in. What the central banks do, again, this is a chart from the Federal Reserve. What the central banks did is, if I go back to the chart where I showed you total debt, and I said total debt fell, what the central bank need to do is make sure that total debt is rising. So how do you increase debt? Well, if the consumer is unwilling to borrow, companies are unwilling to borrow, who's left? Well, then it's the central bank's turn. The central bank must borrow because economic theory says increase debt, you increase economic growth. And that's what central banks around the world, primarily the big four, which are the ECB, the Fed, the Swiss National Bank, and the Bank of Japan. All they did was start buying out debt. And when they ran out of debt to buy, they started buying other financial instruments. What happened in the US, for example, if you can see throughout their economic history, they've never had a balance sheet this size. And today, the big news is how are they going to reduce this balance sheet? It's roughly $4.5 trillion. It's never been this big ever. Because they've been buying not only government bonds, but they also resort to buying mortgage-backed securities and other types of debt because they needed to buy, because increased debt, you increase GDP growth. However, that didn't quite work out as they expected. If I combine the four central banks around the world and show you their balance sheet, this is a study from Deutsche Bank, you'll see that this graph looks a bit odd. This has never happened before in history, where all these central banks are buying assets at the same time in order to stimulate economies, which in effect are not really being stimulated. What has happened in return? What's happened in return is something else that's never happened in history. We're seeing negative interest rates. Now, there's a book, I'm not sure if you've heard about it, called Debt, the First 5,000 Years. It studies the history of debt for 5,000 years. And throughout the 5,000 years, when has debt and interest rates on debt been negative? Never, not until today. What's happened in European countries as well as Japan, you're seeing deposit rates negative, meaning that if I'm holding my money in a bank, every year the bank is taking money from me as a privilege to holding that deposit with them. And it's particularly strong in the Nordic countries, Denmark and Sweden. The two objectives central banks had for buying this debt is to stimulate economic growth. And what they meant by stimulating economic growth is, number one, they wanted to see inflation. They all had an inflation target of 2%. And the green line you see here is the 2% target that they had. They all said, we're buying all of these financial assets because when we buy these financial assets, we're stimulating economic growth. Therefore, we will see this inflation rise as we expect. Well, in Japan's case, that yellow line, it's not very clear there, but that's when they started a huge quantitative easing program, which is another word for buying out debt and financial instruments. That's when they started the program, and it immediately had the opposite effect of what their economic theories tell them. Their inflation has been going down. They haven't hit their target. Today they're a little bit close, but they're still not hitting it after years and years of buying all these assets. The European Union, the same thing. All of their stimulus, they're not seeing this. In Japan, because they have negative interest rates, they have two interesting phenomena right now. Number one is they have a shortage of the largest note, which is a 10,000 yen note. They have to keep printing because there's so much demand. Why? Because the Japanese are preferring to put their money in safes at home because they don't want their money to be taken in the form of a negative interest rate of the bank. And of course, famous investor Warren Buffett said that if they do the United States, he'll take all his money out of the banks. Here's another interesting one. This is the Central Bank of Switzerland. They've done something none of these banks ever thought they would do. They have an $84 billion stock portfolio of U.S. stocks. The Swiss Central Bank is one of the largest holders of Apple in the world. They're one of the largest holders of Apple shares, along with ExxonMobil, Amazon, Johnson & Johnson. what does a central bank have to do with buying stocks, not only in this country, but in a foreign country? This has never happened before. So we have central bankers as shareholders. As a result of their quantitative easing, they're running out of things to buy. That's one reason. The Bank of Japan doesn't know what else to buy. They're buying up almost all the debt they can buy. They're buying up, the European Central Bank is doing the same. That's why interest rates in Europe are so low. Interest rate on a Spanish or Portuguese bond now is cheaper than the US, which from a market perspective, that tells you Spain and Portugal are less risk than the US, which is absurd. In Japan, they also resorted to buying stocks, but they're a little bit smarter than the Swiss, or so they think. They went to buy only local stocks. And they bought this through the fund market. Instead of buying stocks directly because it could have conflict of interest issues, they said, okay, we're going to buy through funds, primarily ETFs or exchange-traded funds. Japan, the Japanese central bank today has almost 70% of all ETFs in the country. They own them outright. The other Japanese investors own 30%. By year end, it's expected that the Japanese central bank will control 80% of all ETFs in that country. 80%. The US Federal Reserve in 2015, it's downloadable, they did a research on how effective is all of this quantitative easing. And what they found was the two objectives of quantitative easing, which is increasing inflation and increasing economic activity, there's no proof. On top of that, what they said was two countries that have been doing this longer than any other country are Japan and Switzerland. What has been the effect? What they found is the longer you do it, the opposite effect it has. So what they found was not only is economic activity and the inflation slowing down, and in some cases, they have deflation. So the economic theory that they're using is actually the opposite. It's not working. But why do they still do it? If it doesn't work, why do they still do it? They have one tool, which is buying assets. That's all they have. So if you only have this one tool and it doesn't work, you just keep using it until hopefully one day it works. This is a history of government bonds interest rates around the world. I highlighted a few here. And just to see when have we seen negative interest rates on bonds. And if you can see Switzerland, Germany, US, and Japan, actually US hasn't gone negative yet, but the other three are all negative today. France, Sweden, Netherlands, all negative today. UK, not quite negative today. But as you can see, what we are in today, we've never been in before in economic history. So if someone were to tell you, we know what we're doing, we know how to solve it, we know the solution, we've done this before, and we know the outcome, it's not true. What is happening today, especially among central banks, has never been tried before, and the outcome is nobody knows what the outcome would be. We all think the central banks are leading the market, especially when it comes to rising or lowering interest rates. This is from the Federal Reserve. This shows you when the Federal Reserve raises interest rates. Of course, everybody around the world, before they raise interest rates, that's the talk of the town. They all give their forecasts or anticipation. Will the Federal Reserve raise interest rates or will they not raise interest rates? Well, it's never a mystery. You always know in advance what they're going to do. Because the Federal Reserve never leads the market. They actually follow the market. Interest rates always rise before the Federal Reserve does. And here's a good case. The blue line is the Federal Reserve when it raised interest rate. The yellow line is actually when the Treasury market started rising. And as you can see, it was roughly flat until the Treasury market began to rise in November 2015. As soon as the Treasury market began to rise, all of a sudden the Fed says we're raising interest rates. The Treasury market kept rising. Whenever it rose, the Federal Reserve followed it. This has only been since the Federal Reserve raised interest rates beginning in 2015. Well, what happened before that? Well, before that, as you know, we had a period of roughly zero interest rates. So it's hard to see when the Fed followed or if the Fed led. But if we go back to just before the financial crisis, we can see the same scenario playing out. Treasury markets, meaning the US government bond market, interest rates were falling, the Federal Reserve was following. And they followed them all the way to zero. And actually, if you see the Treasury market went to zero months before the Federal Reserve went to zero. So the Federal Reserve followed the market all the way down and is following the market on the way up. The Federal Reserve does not lead the market, which also says the Federal Reserve is not in control of interest rates. The market is in control of interest rates. The next crisis, of course, will be blamed on the central banks because of all the experimental economics they've been doing. Oil, this is one of my favorite topics and probably one of yours. It affects us all. This is what we're showing in the media. The good guy, bad guy. The cowboy versus the desert guy, I guess. Good versus bad, right? The title here is Chic versus Shale. And this is when oil prices start to fall. Of course, who was blamed for the fall in the price of oil? OPEC and Saudi Arabia particularly. All right, well, were they to blame for the fall in oil price? We have to look at, first of all, is OPEC really in control of the oil price? This is history of the price of oil, and I went back as far as I could go, which was April 1991, all the way to September, roughly about 2 weeks ago, 2017, to see what's happening in the price of oil. And I shaded the area for you because something strange has been happening in this area. It's never happened before in oil. Why has it happened only recently? In the past 10 years, oil has behaved in a way that we haven't seen ever in the history of oil. What can be explained for that? I'm going to go through 5 points, and I'll kind of give you my view of what's happening. Point number 1, we have really a 13-year period here. And in this 13-year period, we never saw oil go above $40 a barrel. And if you talk to economists and financial analysts and you ask them, why does oil rise or why does oil fall? And they'll all highlight geopolitics. Today, for example, they'll say, oh, North Korea. They'll say what's happening in Syria. They'll say Russia. They'll say a war here, a war there. These are all geopolitical matters that will affect the price of oil. But in this 13-year period, we didn't see that. This is at the end of Iraq's invasion of Kuwait. This is the Asian financial crisis, the Russian ruble crisis, dot-com bubble bust, September 11 attacks on the United States, U.S. invasion of Iraq, U.S. invasion of Afghanistan. None of this crazy geopolitical stuff affected the price of oil so much. Wasn't until here. What happened here? Well, in early 2000, the Commodity Futures Modernization Act, fancy name, but what it meant was regulators decided that they will allow banks, because banks are sophisticated enough, to be able to create and trade derivatives amongst themselves. And this goes back to my whole theory of financialization, taking something that's a normal asset and financializing it, and that's what happens. So what this act did was it allowed banks to create derivatives amongst themselves and trade amongst themselves without any type of regulated market, because banks are sophisticated enough to be able to understand what the risks are. What happened in this period here, which is roughly around the end of 2015, was they allowed, or not allowed, but they launched for the first time oil-based derivatives and oil-based ETN, which are an exchange-traded fund based on a commodity, an ETN, an exchange-traded note, and that's what they use for commodities. Oil was among them. And if you look at the commodities market over the past 10 years, they've had a similar pattern of behavior. So once the financialization of oil was allowed, you saw the oil price shoot up. And it shot up to a record level we've never seen before. It shot up at the fastest rate we've seen, and it fell at the fastest rate we've seen. Why? When oil fell here, of course, the common answer was, well, oil fell, global financial crisis, right? I mean, this is why oil price fell. Everybody was suffering. Demand was falling. Global recession. Oil fell 75% in 5 months. Did demand fall that much? Did economic growth fall off that much? No. It's because lending locks up, credit dries up. When lending and credit dries up, banks did not trust each other. When banks don't trust each other, Lehman Brothers fail, what happens? All of the derivative products they're trading, they're traded on what they call the over-the-counter market, meaning person to person, or actually entity to entity, because it was an unregulated market. Oil derivatives, other derivatives, stopped trading. Because if I don't trust you to pay me in the event of a loss of this derivative, I'm not going to issue it to you, I'm not going to trade it with you. Not only did credit markets freeze up during this time, but derivative market froze up during this time, and that's what caused the massive fall in the price of oil. Yes, financial crisis was the instigator, but the real reason for the price of oil was not a rapid drop in demand or a recession, because during this period we also had recessions, and we didn't see the price of oil fall so much. When the price of oil rose again, we also heard the news saying, well, this is OPEC driving up oil prices, this is the shale industry ramping up their production, this because of the shortage of demand, that China's hungry for oil, they can't keep up with the demand. Well, the International Energy Agency, which is the US agency that tracks energy markets, said that there's actually too much supply. There was oversupply in the market during this period, yet oil prices shot up again. It wasn't a supply-demand issue. Supply-demand didn't bring this back up again. What brought back the supply of oil was, here we had global financial crisis. What happened then is central bank to the rescue. What did central banks do? They injected liquidity. They rescued all the banks. As soon as the banks felt comfortable again, they were back to their old game of trading derivatives, and the market went up again. Because of the financialization, as soon as banks felt comfortable again, then they started doing their normal behavior again, which is speculation, high risk investments, etc. Oil price went up. But then again, something else strange happened. Oil fell again in June 2014. And when this fell, this is when you saw the headline of The Economist saying, shale versus sheik. Saudi Arabia is lowering the price of oil because it wants to punish shale and drive them out of business. I say it's more like Basel III. And for you in banking, you probably know Basel III rules. I'll get to that in a minute. Here's the US production of oil going back to, I guess, ever since they could go back in the 1800s. But what you saw here is a rise in around 2005, 2006. This is solely because of shale. Shale allowed the US to be a major producer again, but it wasn't technology that made shale viable. It was actually the price of oil that made shale viable. The only reason shale was allowed to become an industry was oil price shot up. Oil price shot up not because of supply-demand, but because of the financialization that caused oil to shoot up above $100 for the first time in history. Now these guys have an incentive to get into the shale market. Now, if we look at Basel III rules, what did Basel III say? Basel III is based in Switzerland. It's part of the Bank for International Settlement. They're the ones that issue all the rules, and they give them to central banks around the world to follow. What happened after the financial crisis, as I showed you in the first one, the 4 points of what caused the crisis and what the solutions are, Basel Committee was hoping that central banks in these countries will see what the problem is and try to solve the problem. When they did it, they gave them years to try to comply and try to see what central banks do. They didn't break up the big banks. They didn't regulate derivatives. They didn't do any of the issues that caused the crisis, so Basel said, we're going to step in. Basel III rules make sure banks are stronger by having a higher number of assets, but also what they did was they raised the margin on banks' derivative trading, meaning that if you want to have an over-the-market or unregulated derivative on your balance sheet, you need to increase your margin. We want to see that increase. And Basel III rules took effect beginning January 1st, 2015. So what that meant is before January 1st, 2015, banks needed to either increase the margin, which means increase their capital, which is a difficult thing for them to do, especially European banks, or get rid of their derivatives, start selling them off because they're too risky for them now. So what happened in late 2014, as you can see here, the derivative market, this of course is from the Bank for International Settlement, or BIS. They track the market around the world, and the market increased all the way up to $710 trillion in 2013. And as you can see, it's down right now to about 493 trillion, or roughly 6.2 times global GDP. So the derivative market is 6 times greater than the global economy. It's come down though. And it's come down beginning in 2014. primarily because Basel rules put restrictions on these banks. They had to start selling some of their derivatives. As a result of this, not only did they have to sell their interest rate and forex derivatives, which are the primary market of these products, they also started to sell some of the commodity derivatives. And if you look at the balance sheet of some of these banks, as a whole, according to the BIS, they don't break it down by industry or by commodity, but commodities in general, from 2014 to end of 2015, came down 45%. If you look at bank specific, and I went back to Deutsche Bank, for example, because they break it down by commodity, their oil-based derivatives from 2014 to 2015 came down over 60%. And this fall in derivatives is one of the main reasons why we saw a fall in oil price. And as you know, derivatives are very complex. They're intertwined. We're dealing with a complex system. It's hard to understand what happens in one because you might have a small pop in one, but it can affect the whole market. And that's how delicate the derivative market is. And that's why central bankers in their home countries were a bit worried about trying to regulate this market because they don't know the outcome. But Basel Committee decided to act for them. If we take a look at the derivative market and the price of oil, as you can see, the oil is the blue bar, or blue graph, and then the bars are derivatives. You can see they almost go line in line of how they grew, how they came down, and how they've stabilized now. However, they've only stabilized temporarily because Basel rules go out to around the year 2019. And every year there's a milestone for banks showing higher margin on derivatives or lowering their derivatives. So not only are the number of derivatives coming down over time, over the next few years, but with it, I think it will take the price of oil as well. Going back to more recent history, we all know beginning January 1st this year, which is this little circle right here, that's when OPEC came up with this historic agreement to lower production, to increase the price of oil. And everybody was cheering, saying, yes, okay, OPEC controls the market, what they say will happen. The orange bar, that's the Brent forward curve, or meaning that's what the market was expecting would happen after the OPEC meeting. They expected oil prices to steadily rise. What happened, however, is the oil price did not. Oil price was actually rising before the OPEC meeting. After the OPEC meeting, the price fell up to 20% and only recovered recently. I think today is trading at the price it was trading January 1st for the first time this year. So the OPEC meeting really had no effect on the oil market. Oil market was already rising. Once the OPEC agreement took effect, markets went down. There's something else that happened here too that never happened before. Before the OPEC meeting, OPEC members met with hedge funds, commodity traders, and market speculators. Why? Because they needed help setting the price of oil. This is the first time OPEC publicly acknowledged the role hedge funds and traders have in controlling the price of oil. And for those of you that follow the price of oil, you know that oil is not traded among the users of oil. It's actually traded on a forward market. A forward market by its nature is a type of derivative, but it's a regulated derivative. So the hedge funds and the commodity brokers, they're the ones that control the price of oil. And if OPEC wanted them, or if OPEC wanted to stabilize the price of oil, they needed them to help. And yes, for the most part, they did agree to help. But of course, they have their own interests involved as well. So, bottom line here is the price of oil, I believe, is headed lower, and it's going to stay lower for longer than most people anticipate. What this means is that governments and entities and even businesses in the GCC need to have a scenario. If you ask them what their scenario is for lower oil prices, they don't have a scenario. They say whatever the oil price is today, we'll carry it flat for the next couple of years. Why? Because it may not go up, it may not go down, we're carrying it flat. But what if it doesn't? What if it doesn't stay where it's at? What if it goes lower? What's your scenario? Most governments do not have a plan for this because they're so dependent on a higher oil price. Stock market. We all love the stock market, right? This is the stock market in Saudi Arabia, which is Tadawul, the Dubai financial market, and the Kuwait stock market. As you can see here, if you've invested in the stock market in 2006, 7, or 8, you're still losing money. The markets in the Gulf peaked over 10 years ago and they never recovered. Despite the fact oil price recovered, despite of all these things, the stock market never recovered. It attempted a few recoveries, but what's interesting to note here, this is the high for Kuwait. It recovered here, people were happy, and it recovered here. Never again, the highs are getting lower than previous highs. Same with UAE, same with Saudi Arabia. And in Saudi Arabia, I know Kuwait, they're talking about Kuwait becoming emerging market status, and that's going to be great for foreign investors. When Saudi Arabia announced that it's going to allow foreign emerging market status, you can't see it here, but this little blip, that was that part. People got happy, emerging market status, and then it came down again. So markets in the Gulf, by their nature, I think are speculative. And most of you out there are probably more experienced in this than I am with local markets, but it's not really a long-term investment. I mean, if you invested 10 years ago, you're still losing money. What about the Dow Jones? If we remember economic cycles, economic cycle every 4 to 7 years, we have a cycle. Here was one cycle here. This was the last financial crisis. Stock market up 93% and then down. Of course, there's a saying that stocks go up in an escalator but come down in an elevator. And that's kind of a scenario you're seeing here. What's happened now is, if I were to tell you to invest in 2009, 2010, I said, invest now in the stock market. It's the best time to buy stocks. You'd say, I'm crazy. We're going through a crisis. It's bad. Companies are falling apart. No, that's the best time to invest. But now I'm being criticized because when I see this, I say, you know what? I'm not going to invest in the stock market now. I think I'll take a break. You're crazy. Everything's going up. Stocks and gold have something in common. When they're cheap, nobody wants them. When they're high, that's when they become desirable. But that's when you need to take a step back and look. Because if you understand that we're in a cycle, you have a cycle, it's a pattern. It may not always equal the same size pattern, but it's a pattern. It goes up and down, up and down. If it's up 233%, I'll take a break. I'll wait it out. Because for me, the buying time is here. That's when you want to buy. If we want to see the health of the market, I took a look of some of the recent IPOs, particularly the tech IPOs, because that seems to be what a lot of people are concerned about. And these are some of the 3 most talked about IPOs in the US market, Silicon Valley ones, Twilio, which I wasn't really familiar with, Snapchat, a lot of us are familiar with, and Blue Apron. All of them are lost half their value since IPO. If the stock market is so healthy, this is one thing you should see, is IPOs should be doing great, especially these hyped tech IPOs, but they're not. As a result of these failures in these IPOs, what's happening now is there are currently 154 companies awaiting IPO in the US. Very few of them are tech. They're biotech, they're healthcare, they're industrial, they're manufacturing. Very few tech. But what's more interesting is 216 IPOs were withdrawn because they don't see the market as healthy. But the market is healthy, isn't it? It's up 233%. This should be the best time for these IPOs because the suckers are at the end of the market, but they're not there. So GCC stock markets peaked a decade ago. They don't show any sign of recovering. And US as well as global markets, I think, are pretty much at a plateau. If they rise a little bit more, I mean, what are they going to rise another 3 to 5%? I'd rather wait it out and find a better buying opportunity. China, another one of my favorite topics. People think China is so strong, but actually it's the opposite. It's a house of cards. Rogoff, who's a famous professor and author at Harvard University, says China is the largest or the greatest risk to the global economy. This is what I showed you earlier. Fitch, their bad debts are 10 times worse than expected. And China's GDP is the worst it's been in 25 years. This is a report from McKinsey. They track global debt around the world. This is specific to China. And this is, of course, in trillions of dollars. I know the figures are small there, but I'll read them out to you. In 2007, China's total debt, this is government, consumer, corporate, was $7.4 trillion. As of Q2 2014, it's much higher now, by the way, it was $28.2 trillion. So it increased by $21 trillion in 6.5 years. The US gets criticized because the US government has 20 trillion outstanding debt, and people always say they're never going to pay it back, the debt is too high. But it took the United States over 200 years to accumulate this debt. It took China 6.5 years to beat it. This is from the IIF, which is the think tank in DC. It also tracks financial flows and banks. Shows China's debt to GDP ratio at an extremely high level. Not a level that should be for an emerging market. This is a level for a mature, slow growth economy. China just overtook the European Union and the United States as having the largest banking system in the world. By that they mean largest debts. Bank is all debt. So Chinese banks have more debt than the entire US banking system and the entire European banking system, and actually almost it has become the largest banking system in the world because of all the debts. How are these debts doing? The red bar here shows you the growth and credit in the US before. This is due to the subprime, and this is China today. China is almost mirroring the US, but at a faster pace. There's a very long and very detailed report done by Reuters not too long ago. This is from May this year. They call it ghost collateral. Of course, all these banks in China took out loans based on asset. You don't give somebody money based on nothing. You give them based on a collateral, an asset, a commodity, a building, a manufacturing facility. Reuters sent some investigative journalists over to China to investigate some of this collateral. And what they found out is many times the collateral the banks were pledging did not exist. Or if the collateral was there, meaning that I'm going to give you my building as the collateral for me to take out this loan. That same building was used maybe 10 or more times for a similar loan by different companies, pledging the same asset. And in one case they mentioned here is they're using it for commodities, copper in particular and iron. When the Reuters team went to the facility to check on the iron or the copper, it wasn't there. Where's the collateral? That's why they call it ghost collateral. It doesn't exist. China has been doing all of this stimulation through debt because the same theory that the Europeans and the Americans were doing. You stimulate by issuing all this debt, you're going to get economic growth. And that's what China was hoping for. By doing so, their exports and imports have been trending down since they've started. This is China's GDP. As you can see, it's the worst it's been since 1990. And it's trending down. They say it's a managed slowdown. I've never seen a managed slowdown happen anywhere in the world. So this is a managed slowdown according to China. This is the industrial production of China, retail sales, and fixed asset investment. Fixed asset means if I'm investing in new technology, new manufacturing facilities, new growth for the future, they're actually not. They're slowing down. Where's all this debt going? It's being used very, very efficiently. Another thing we heard here in the Gulf, and we've heard it, Saudi Arabia as well. They have so many U.S. Treasuries they can sell and bankrupt the U.S. China actually is the largest foreign owner of U.S. Treasuries. The largest single owner of U.S. Treasuries is the Federal Reserve. Number two is U.S. investors, primarily through funds. If we look at foreign investors, the largest, of course, is China. China at one point had $4 trillion in foreign currency reserves, primarily through U.S. Treasuries. Over the past year and a half, they had to sell $1 trillion worth of it. So the myth of China being able to sell its treasuries to bankrupt the U.S. is absurd because they can never do that. Their economy is linked. Why did they lose this $1 trillion over a 1.5 year period? Defending their currency, defending capital outflows, because they've had money leaving China at a record pace. You go anywhere in the world, you see the Chinese are buying everything. Why? Because that's the best way for them to get their money out of the country. And defending their currency, that's the result. So if they continue to defend their currency, all their reserves that we talk about make China so powerful will quickly disappear. And of course, China's headed for a major disaster. I mean, that's the conclusion I come to. All right, I'll wrap it up with some conclusions, and then I think we'll have time for some questions. We're on a boom and bust cycle. I mean, this has shown over the past couple hundred years. There's nothing new here. Financial crises not only occur frequently, they occur more frequently than you think, and they're becoming more severe because of two things. We have debt that's linked to economic growth, and we have central banks that are not only not aware of the problem, but they come up with wrong instruments and wrong tools to fix the problem. If we study financial cycles, we know that we have a growth, a peak, a slowdown, and a recession, and it's clear that we're at a peak. And if you look at central bank projections, I went to the IMF, the World Bank, and a few other international agencies, and they have financial projections for economic growth out to, I think the longest was 2022. And not in that single period did you see a recession in their projections. They all project going like this. Now, that would mean a record in world history that there would have been a recession in over 15 years. That's never happened. So all the projections are always showing you an increase. They never show you, all right, we're at a peak, this is a cycle, we'll have a slowdown and an increase again. Record low interest rates are causing massive distortions in how people invest around the world. Because of low interest rates, it's causing people to invest in riskier assets. I heard of sovereign wealth funds, not only here in the Gulf, but outside the Gulf, saying that they need to go invest in private equity and real estate and other types of assets around the world because they need to get a higher return. They're not getting it with safe assets and safe investments. That's a wrong strategy to do because, especially when you're at a peak of an economic cycle, when things go down, you're one of the losers. Oil is headed lower and will remain low for longer. Stock markets are riskier today than they have in the past decades, and this all goes back to financialization that we've seen over the past decade. China's headed for disaster. That's my last one. Now, I always try to give recommendations, and I know they're fairly general, but every situation, every institution, every government, every individual is unique. But these are some rough points here. Nothing outperforms cash when everything's going down. GCC banks are safer than European banks. So if you think you have your money stored away in a European bank for a rainy day, well, it's better off in the GCC than it is there. The majority of assets lose value. People say, well, what about gold? What about real estate? Yeah, everything goes down. Some more than others, but everything goes down. We're at a peak of an economic cycle, which tends to be the worst for stocks. Stocks are the most sensitive to economic cycles. Only the highest rated bonds are worthy of investment. Junk bonds are called junk for a reason. Expect many banks, companies, even countries to go bankrupt. We saw this in the last crisis. Greece was close to bankruptcy. Iceland was bankruptcy. Ireland, Portugal. This time around, you'll see even more. Expect governments and central banks to restrict the movement of your capital. If you want to send money to your brother in the US, maybe you won't be able to. I don't know. There will be restrictions imposed. There are already restrictions in several countries around the world. China had restrictions. Cyprus had restrictions. Greece used to have restrictions. We'll see this cycle increase, but it'll be more countries this time. And of course, if you want to be one of the winners in the end, go back to that Dow Jones chart. Buy when it's low and don't buy when it's high. And that's it. Thank you very much.
Debt is always there. Derivatives is a purely regulatory and technical matter. Similarly, ease of credit and banks are too weak to pay. These are regulatory political, which reflects a policy in the biggest economy, which is the US economy. And it is really the invisible elephant which we did not discuss in this meeting today, and that is the core of the issue, is that it is not China that we should be watching for a collapse, but the US economy, which is teetering on the edge of the collapse. China did go double digit in the beginning, but it started from zero. And at 6.5, 6.7% at present is very attractive, especially that it still hasn't developed and is in the process of developing its services sector. At the moment, it is a net negative on its balance of payments and balance of trade. So China still has way to go, as well as as you mentioned, ghost banking. Also, there's the shadow banking, which is being controlled. But shadow banking exists. I mean, all the U.S. derivatives are shadow banking, basically, and everything. So these issues exist everywhere. But the imminent collapse, I think we should be watching for the U.S. market. As far as protecting GCC sovereign wealth, we happily, at least Kuwait, doesn't have a lot stuck in US Treasuries. Just 20, 30 billion. But the investments in Western Europe equities will eventually demolish our sovereign wealth reserves once the crash does happen. How do you see a way to preserve these? I believe owning equities or bonds or treasury bills is a suicide one has to avoid and go into direct full ownership. Thank you.
One more question, please. A question about, we have covered in this presentation the negative risk area and the Gulf region and Middle East and the entire global level. But I need to know more about the positive risk, the opportunities that you can see, especially in the Middle East field and the upcoming period. What's exactly your recommendation for medium to big size companies in the opportunities that expected in the next or upcoming period? Thanks again for this professional presentation.
Because you never know how much debt a system can bear until it finally snaps. And what could cause it to snap? There could be many triggers. Some of the triggers could be something geopolitical, could be a problem financially, but how much debt the system can hold, I don't know. It's like saying, well, when will the crisis begin? Well, there could be many triggers to it, I don't know. What the central banks tend to do is, especially when Yellen was saying no other financial crisis in our lifetime, what she was referring to was what central banks always do. When there's a crisis, they look at what caused it and they try to put a sticker on it, fix it so that doesn't happen again. But a financial crisis never repeats itself, meaning that if the last crisis was subprime US housing, the next crisis, that's not going to be what causes it. The one before that was dot-com bubble. So the solutions a central bank applies to fix one problem is actually what causes the next one to happen. It causes the simulation that creates the next one, the bubble to happen. So for example, during the dot-com bubble, what happened was the US central bank decided to lower interest rates and encourage home borrowing. That created the housing bubble. What happened since then is, as a result of this stimulation that the central bank has done, it's led to other asset bubbles to form because they're trying to stimulate with all of this free money. And that's what's leading to the cycle that we're in. So how much can we go? How much longer? I don't know. There's no clear answer to that. The next one was the difference between consumption debt and production debt. And yeah, that's clear. And of course, consumption debt is wasteful debt. It's really unproductive, does not really add much value to the system. You want to focus on the productive part of the debt. Have not we learned from previous ones? Well, I mean, we seem to learn, but what we seem to learn is how to prevent the previous one from happening. The previous one never repeats itself, but you get some other form of it. So throughout, if we study economic history and economic booms and busts, we keep having this cycle. And the cause is not the same as the previous cause. So yeah, we try to learn, but it never really works out. The final one was, and you said the next crisis, or as a result of this early warning and such, does it reduce the intensity? And because of the financialization, the high amount of speculation, the high amount of debt, the higher debt you have, as I said, when things are rising, you do well. When things are falling, you do worse off. So as a result of all the problems that we saw that were there during the last crisis, today not only are around, they're actually bigger. The next one will be more intense. How intense and what industries it affects and what countries it affects, it's anyone's guess, but it'll be more intense. The last one was on the business cycle, and there's no correlation with debt. I think there is some correlation with debt because the business cycle, yes, is based on supply-demand, and the whole purpose of central banks trying to stimulate through their massive program was to try to stimulate demand, and it hasn't been very effective. And you can see that especially with all the stimulation in China. China has stimulated more than any other country, and in order to try to stimulate local demand as well as export demand, and we haven't seen that. There are some early warning indicators, and as you mentioned, yeah, there are lagging indicators, and how well they're used, it's anyone's guess. But for the most part, central banks never see a crisis coming. And actually, I don't think I've seen in the research I've done a central bank that said, you know what, there is a crisis coming, we're slowing down, we're implementing these emergency strategies. It's never happened. Central banks are always reactive, they're not proactive. And I think that's it for these questions.
We'll take another batch of questions.
All right, the first one is lack of regulation. And is it because we lack regulation, or how do we stop a crisis from happening? Particularly in Kuwait, I don't think there's a lack of regulation. I think there's plenty of regulation here, especially if you look at central bank regulation, capital markets regulation. There's plenty of regulation. No, he's talking about Kuwait regulation. Not your question, the other question. So regulation here, I think Kuwait is a well-regulated market. I think in general, if you look at the GCC banking market, it's a fairly well-regulated market. I don't think increasing more regulation is a solution to anything. But can increasing regulation avoid a crisis? I think where the GCC banks are today, for example, in Kuwait, they have limits on bank exposure to what type of assets they can have. They have limits to their derivative trading, etc. So I think that's already well placed. When I talk about concern about banking, I mean the big mega global banks that have a free license to pretty much do any financial product or instrument they want. The next question is on, you said the presentation was very technical and not economic. I think there's somewhat of a balance there. But then he said your fear is on US, not China. And I really don't think the fear is US. I said, yes, the US is the largest economy. And people tend to blame the US for all this massive speculation. Okay, the financialization, the whole term of all these high risky assets probably were developed there and came out of there. But China is more risky than the United States for several reasons. First of all, US Treasuries, German government bonds, UK government bonds are probably one of the safest investments you're going to get, unless you want to have gold sitting in your basement somewhere. Those investments are pretty safe. The US is much safer than, I would say, China. One reason is because they have the world's dominating currency. Almost all assets, 2/3 of all assets, more than half of all debt in the world is in US dollar. What happens when you have a crisis? Whenever you have a crisis around the world, there's a rush to buy dollar, regardless of whether the crisis is in the US or elsewhere, because people need to repay their debts, and they need to repay their debts primarily in US dollar, whether it's Turkey, whether it's in Malaysia, whether it's Indonesia, whether it's China. And China's currency is linked or tied to the performance of the US dollar. So they don't have a fully convertible currency yet, which I don't think China will ever reach that fully convertible currency, because to have a fully convertible currency means that they're taking on an unusually high risk and trying to play the balance of payments game that the US has been playing. As you know, the US has a negative balance of payments. They need to make sure that the dollar is available to anybody who wants it in any foreign country. I don't think China is prepared to do that. They might have a strong currency, but to be the dominating currency, I don't think they're prepared to do that. China economic growth has been amazing. It's been spectacular. It's been one for the history books. The country has not had a recession in over 43 years. The last recession they had was in 1974, before their opening up of the economy began. So they're not prepared for a recession. They don't know how to handle a recession. But yes, they're having a slowdown, and as you said, their economic growth of even 6.7%, which is roughly where they are today, is very impressive. But for China standards, that's very low. They cannot service their debt with that low of an economic growth, because as you said, not only do they have the public debt that I showed you, they become the largest banking system in the world because of their debt. Government is borrowing at a higher rate. They have shadow banking, which is another $7 to $8 trillion according to estimates. All of this debt that China threw out into the market with the hope of stimulating this demand, stimulating this growth, is not happening the way they saw it. So you have debt rising and GDP falling. It's like your income is staying the same, or your income is falling, but your monthly payments on your mortgage are going up. You can't survive like this. And then the last point you made was on preserving sovereign wealth. As I mentioned to you, I mean, preserving sovereign wealth, one thing I know that the sovereigns do is, or even here in Kuwait, for example, they avoid the highly speculative, like derivatives and things like that, which is a good sign. There also, one disturbing trend that I saw is that they're looking to move into higher returning investments. And these higher returning investments this late in the game may not get the performance you want, i.e. you'll end up losing money. But of course, to have the best preservation of wealth, you have to be very conservative right now, and especially for a sovereign fund. To try to chase for a higher return somewhere else is not the answer. It's better to be safer and preserve what you have than trying to go after growth. And I think the whole purpose of the sovereign wealth fund is to preserve wealth and not to achieve high growth numbers. So I'm not sure where they're going there. The third question from Wa'il sitting over there was on what are the medium to longer term opportunities. Well, I think the first thing we need to do is have that scenario in mind that, yes, we are dependent on the oil wealth. Number one, or number two is, we do have a lot of wealth already, so let's take some of that wealth and invest it locally. That's one opportunity. You're saying the sovereign fund. Well, most of the wealth is invested outside. Well, some of the wealth can be invested inside in developing industries, developing certain sectors. That's an opportunity, because when everything around you is looking bad and you need to chase a higher return elsewhere, why not look at your home country than going far off to some other country? So the opportunity, I think, is, yes, it's a sad scenario, because if oil prices go lower, that naturally means everybody here who has real estate is going to have a lower priced real estate. It also means the stock market is not going to be performing so well. But the opportunity is, now is the time to start investing in local industries. And by that, you mean opening up the government, encouraging industry, encouraging economic growth, encouraging entrepreneurship. That's the opportunity that I see.
Thank you, Bob. Will allow
في المعهد ومركز السياسات. صراحة احنا استمتعنا وايد بالمحاضرة من أخوي طارق الرفاعي من Quorum Strategic Studies. أنا تعرفت عليه صراحة بالصدفة، ولكن كانت معرفة جدا رائعة بأن يوجد لدينا كويتي قاعد هناك طول عمره برا doing studies في أمور متعلقة في الجلوبال ماركت وفي الجلوبال economics. Given that he's an ex-banker, I'm not sure if he's doing still the banking business. It's very speculative, وبنفس الوقت is very informative. He has his theory on the derivatives, on the financial instrument. You might agree or disagree, but it's very intuitive and very interesting. هذا اللي أنا أقدر أطلع فيه بهذا الconclusion. لكن في النهاية, he reached the conclusion, and let's think about investing in our homeland, and let's go back to our bases. يعني هذا الكي مسج أتوقع اللي أقدر أنا أستفيد منها هني في التخطيط في هذا الموضوع. طبعا هذا الموضوع ممكن يتشعب, but at the end of the day we do not put all our eggs in one basket في النهاية. أحب إني أشكركم جميعا. أعتقد أخوي طارق موجود available for how many days يعني في الكويت؟ يقولون couple days. الأخوة المستشارين الموجودين معنا في الأمانة يعني راح يجتمعون معنا. They will be having an interesting meeting. You can join for more elaborative one-to-one agreement, disagreement, taking the heat. I would love everyone to play the devil advocate. This is great. And this is what makes the discussion more fruitful. And let's end up with some reporting. And this is what I wish my economic advisor here in the GSCPD to come up with a draft of what they can provide out of these strategic studies. في الختام أشكر الجميع على تواجدهم وأشكر أخوي طارق الرفاعي على هذا العرض الرائع. Thank you very much.